$500,000 in 1 year. This is the exact master plan that I've put together to show you guys how I've accomplished that in this exact video. And because you guys got my last video to 100 likes as promised, I've put together a very detailed video showing you guys exactly the things I do step by step to help me make $20,000 to $50,000 per month on a month-to-month basis. Now, before I dive into this, I want to give you guys a gift. I've put all my presentation in a mirror board, and if you guys want access to the PDF that goes alongside this video, simply get this video to 100 likes, and I will send each and every single one of you guys a PDF to go alongside this video. And without further ado, you guys have earned it. Here's your big masterclass, free right here on YouTube. So this is that detailed video you guys all wanted to see. And in this video, we're going to talk about 14 things here. I'm going to break it all down for you guys in detail. So this is the only holy grail video you need to watch in order to become a $25,000 per month options trading whiz. Number one is software/brokers to use. This is tools that we're going to use to execute our orders. And I'm starting with this simply because this is where you need to start. You need to know what softwares to get involved with or purchase or start using so you can execute your trades once we get into the detail of actually figuring out where the charts are, where the entries are, where the exits are, and everything. You need to start with creating your account on one of these 4 brokers. There are many other ones, but these are the ones I find are the best, with, of course, the number one being Charles Schwab. This is what I use. This is what I recommend. You guys, again, are more than welcome to use anything that you wish. I just like using Charles Schwab because, as you'll see shortly, it also comes with charting software that we need in order to draw our technicals or come out with our reasons of entry and exit. Next, you're going to want to find a charting software. A charting software will allow you to look at stocks based on the candlesticks that are forming, so you can draw your support and resistance lines, so you can draw your patterns, so you can get involved. So your charting software is going to be one of these. Again, Charles Schwab comes with its own charting software. That's why I like it. Charles Schwab Thinkorswim. TradingView is the most popular one as well. And again, Webull has its own, and TrendSpider is another one that you guys can use as well. Okay, so to put it in perspective, if you're going to use one of these brokers, maybe find one that already has charting with it so you don't have to pay for extra fees. Again, that's why I use Charles Schwab Thinkorswim, because it provides us 2 things in one. All right, now the third thing we're going to talk about in this video is how to draw your support and resistance line. For those of you that already know, you can probably skip this and move to the next step, but I'm going to start here because I want this to be a full detailed video for everybody, not just people who are medium or intermediate traders, but people that are also don't know anything about drawing support and resistance lines. So we're going to start here. If you already know this, you can skip to number 4, where you can learn about my pocket strategy. But for now, we're going to talk about support and resistance very briefly so everyone can understand it and be on the same page. So drawing your support and resistance lines. When we have stocks that make their way up and down, we have 2 ways of drawing support and resistance lines. Okay, we can say this area right here is a level of a pivot or a resistance, and we can say that this area is a level of support. Why? Because price came to it, hit it, and bounced and went upward. Okay, so therefore, whatever happened here is a level that we are like to see or make note of, because that's where we bounced and moved higher. So therefore, as I'm drawing my support and resistance lines, I will go on the charts and I'll draw these lines as they present themselves. Okay, these are all key pivots or support levels that we can draw. Now there comes a time where you'll find a stock kind of doing this. This is also a level that you can make note of, because this is your level of support. Price constantly hits here and bounces. Price constantly hits here and bounces. Price constantly hits here and bounces. And same thing with the top side. Price is always hitting this level and rejecting. So this is your resistance and this is your support. All right. Now, this is all very different from pivots. Support and resistance are clearly areas that we constantly bounce and tag and move toward. Now, pivots are something totally different. I like to use pivots a lot because if a stock is consistently moving up, hits something, and then comes down, and then goes up, hits another point, and then rejects and comes back up, right? I like to identify these key moments where price really moves away as a level of a pivot. right? Same thing with this one. We came down, we hit it, and we moved away. That's going to be a pivot. And by pivot, we mean a pivotal point that can change direction. Now, when you combine a pivot with a level of resistance, now you can say, all right, if price gets above this level of resistance, we now have room towards the next point, which is this pivot right here, okay? So in short, support and resistance are essentially areas that price hits, rejects, and moves down, or holds and finds buyers and pushes up. Anytime we hit a level and move away from it, those are key levels that you want to pay attention to with support and resistance. And I'll look at a live chart for you guys so we can break that down as well. All right, so this is the chart on NVIDIA. Let's take a look at NVIDIA and see where we can come up with these support, resistance / pivots. Okay, so as price is coming up, we're hitting something and we're selling off right here, right here, right here, right here, right here, right? So because we're getting that selling pressure, we can very easily say that this area is a level of resistance. And with that same theory, we can say that there's buying pressure down here. So we can say that this area here is a level of support. Now, in my early days of trading, I used to really focus on coming up with an exact number, but in fact, that's incorrect. When you're drawing your support and resistance lines, you want to gauge an area, not an exact figure. Okay, so in this area from maybe 149 till around 152, that's where you're going to see selling pressure. Or from 129 to 126, that's where you're going to see buying pressure. That is a simple support and resistance formula. Now, when we're talking about pivots, we want to look at something a little bit different. We want to see a move up, hit something, and completely collapses down. So if that's the case, then what we're looking for is this level here to be a key pivot. So that was a key pivot until we went through it on this day, right? So these are little things that we're going to pay attention to. So let's go back a little bit on this chart and see if we can come up with some more levels that we can focus on. Okay, so here again, we can see that we have selling pressure, and selling pressure. So we can say this area is a level of resistance. And then we can also say that we have this pivot. Price came down, hit it, and bounced. So that's going to be a pivot. Price came down, hit it, and bounced. That's going to be a pivot. So right away, you can see we're already coming up with some levels that our chart is going to eventually respect when price gets to it. Now we're going back in history. So because we're going back in history, some of these levels are already now invalidated. So when you're looking at most recent price action, you want to always go to the most recent day, which is right here, and you want to start doing a brand new support and resistance lines that's most recent to what the price action that you're looking at, right? So when we're looking at this most recent action right here, right, we want to look at up to the left for resistance and down to the left for support. In doing that, we can say, all right, up to the left, maybe we have the high of day here as a level of resistance. Up to the left, we have this high as resistance, and up to the left of that, there's nothing else. Okay. Now down to the left, we can see we have some moving averages that may come in the way as support. And down to the left of that, we have this low. Why? Because price came down, hit something, and then pulled away from it. So in the short term, we have some of these levels that we can look at on the daily. Now, if this is too far from the levels that you're looking to trade on the intraday, then you can go in and look at the 15-minute time frame and say, okay, well, the 15-minute time frame actually gives us some more levels, right? We can say price came up here, hit this, and sold off. So that's going to be a level. Price came down here and then bounced. That's going to be one level. And then down to the left again, we have this area here, right? So some key levels that are already in place, even on the 15-minute time frame. So now this gives you a little bit more of a better understanding of where to potentially take your profits and so forth. But these are just levels that we're drawing. We'll get into how to enter, where to take profits, and all that stuff as well. Okay. So again, always start from the daily, look up to the left, down to the left. And then if there isn't enough levels on your chart and you want to come up with more, you can always go to the 15-minute time frame and come up with more resistance and support. Now, given everything that you just learned regarding support and resistance, my pocket strategy really focuses on using those daily levels to find a stock that has enough room for us to take advantage. And what do I mean by that? So an example is a stock makes a significant move upwards, hits something, and then collapses and comes all the way down here, and then starts kind of consolidating like this. Okay. starts consolidating like this. Now, because we know that this is one level of resistance because price hit it and rejected, and we can also see that here we have rejection, we have rejection, we have rejection. So this is another level of resistance. This area right here is the pocket. So if price ever comes through this level, closes inside this level, the next few days we're going to be anticipating a move upwards until this level of resistance. Why? Because when you're in this level, you've already cleared this resistance. Sellers are not going to step in until the next prior known area of selling pressure, which in this case is all the way back up here. So in theory, we have a great opportunity to make money from here all the way up to here, right? Let's say this price is 150 and this price is 200. There's a 50-point move potential here in this pocket that we can take advantage of. Now, this can be day traded or swing traded, and we'll talk more about that briefly. Okay. Now, the same thing can be done on the downside. Okay. Let's say the stock had come from a move up, hit this level, and then bounced, right? A pocket doesn't have to be always on the up direction. It can also be on the down direction. Right? So we can see that there's buying pressure here, right? Because of that buying pressure, we have a level of support. And then when we're looking down to the left, this is going to be the next level. Why? Because price hit this and moved away drastically. So if price comes under this 130 level, we have a pocket from the 130 down to the 100. That's a $30 drop we can take advantage of. So a pocket essentially means there's a clear move down without any consolidation or without any stopping until we start putting this new level, and then above that key level of resistance to the next point is our pocket. This is a little bit different than what a gap is, okay? In this case, we actually have price action on the daily chart that goes down. In a scenario of a gap, you have the stock that kind of moves like this, and then it opens down here and kind of continues pushing, okay? So the hollow area between the last known action to the drop down there, that's a gap. And you see how that's different from what we're trading here? So it's not a gap fill play because there's no price action here. With our strategy, we have price action. It's just drastically moved away from it without any consolidation or, sideways action until it hits some sort of support, consolidates. Then we can take the reversal into that pocket or the breakdown into that pocket. So here's an actual live chart indicating exactly what I was discussing. So we have a move up, we hit something and we drastically drop. As we drastically drop, we put in this price action here and we have this area where we constantly hit. Okay. Now, if we have to draw our line, we can say we have a level of resistance right here, and that's our pivot. Okay. From here to here, this is our pocket. All right. Now, if price was to enter into this pocket, then we would naturally look for a move up until this next resistance point. Let's take a look at what happens here as price navigates towards that pocket and see what happens. All right. So we got a candle close inside that pocket. We got a nice strong move. In fact, we got a spike in volume as well. Also, earnings was on our side. Now, following that move, take a look at what happened. We continuously slowly moved our way into that pocket until we hit this 160, 169, where there's natural selling pressure going to start coming in. And you can see prices naturally rejecting or consolidating here now before it sells off. Okay. Again, just to recap, we need to have a key pivot with nice consolidation. Once price is above that consolidation and there's enough room, that's what we call a pocket. Very different from a gap where there's no price action in between. So we talked about drawing your support and resistance levels, and we also talked about my pocket strategy. Now let's talk about finding stocks to trade. How do we come up with a list of stocks that we can look at in order to trade? So when we're looking to find stocks to trade, we're going to be using a tool called FinViz. right? It's free to use. You don't need the elite version. You don't need to pay for anything. This is an absolutely free tool. It's something I've been using for the last 11 years. So you can use Finviz. You can go to finviz.com. You click on screener and you come down on all. My basic filter that I use has these settings on it. Okay. So we have relative volume over 1, current volume over 500, average true range, and average volume. What this means is we're looking for a relative volume of over 1. Okay. So in relation to the actual volume, we want it to be over 1. We want it to be 1 times bigger. And we want an average true range of 0.75. That means the stock should move at least 0.75 cents on average. And we want the average volume to be 500K simply because we don't want to trade stocks that are illiquid. We want liquid stocks so we can get in and out of those trades. Now, you guys have probably watched my video on how to find stocks. If you haven't, you can click the link somewhere on the screen to watch it. But I'm going to very briefly show you guys again exactly what I do in order to find stocks to trade. All right, so I have the scan filter here. It's scanning for stocks. So what I do now, I put my mouse over this little mini chart that shows up, and I try to find something based on the support and resistance that I showed you guys how to draw, and try to find stocks that are in that pocket or have a candle combo that I like, bullish engulfings, inverted hammers, or something of that sort, right? So for example, let's take a look at Riot here, because Riot looks interesting. So let's take a look at Riot. And the reason why Riot looks interesting is because if Riot can get above this 1470 level, it will essentially be in a pocket with room towards 1582. So I'll keep this on a watch list. I'll put it on chart here. Riot worth watching above the 1472. Above that, it enters a pocket with room to 1587. So I slowly go down this list and I find myself a list of stocks that I want to trade. Okay, it's got to meet a certain criteria. So for example, IREN. Okay, so let's clean this chart up a little bit. So we have a stock that moves up, hits something at 1589, completely drops, and then it has a level of resistance here that we can look at. And if it gets above this level, then it's got a nice pocket with room towards 1590. So I'll continue making notes on this. IREN is now above that 1258, now in a pocket with room towards 1590. Okay, so I continue going down this list until I have maybe 10, 12 stocks that I'm looking at. I put it on a side list, side chart, and then I come back in the morning and I look at it pre-market, and I look at the pre-market levels and see if my thesis is still valid. Okay, if the thesis is still valid, great, then we know what we need to do for that stock. So we've talked about software, charting, drawing your lines, pocket strategy, finding stocks to trade, and how to scan for them. Now we need to establish, should you trade options or shares? So when you're trying to decide whether you should trade options or shares, it really comes down to what your end goal is, what your objective is. Are you someone with a big account size that can trade a lot of shares to see a meaningful return? Then by all means, you could trade shares. And in fact, sometimes that does eliminate a lot of the negatives of options. So what do I mean by that? The average stock, for example, Tesla. Okay. Tesla on average is going to move maybe 2 to 10% a day. Okay. On the share side. 2 to 10%, if you want to make $2,000, it means you would have to buy $100,000 in shares to take advantage of 2%, which equals $2,000. Okay? You have to tie up $100,000 in capital to see a 2% return, to see $2,000. The average person doesn't have this account size in order to see a return. And even if they had close to it, even if they had 50,000, right? And you made 2%, that's still only 1,000. Okay. Let's say they had some of this capital tied up in different shares, different stocks, and different investing. So now they only have maybe, $5,000 that they can invest, right? To tie up $5,000 of your capital only to see $100 return, That's the downside about trading shares. The upside is there is no time decay, so you can hold that share for as long as you want, and it's not going to lose value unless the stock price drops. Okay, so this is all for shares. Now, when we're dealing with options, you don't need a big account size to see big returns. Why? Because when the underlying moves 2 to 10%, the option contract could move anywhere from 30 to 500%. Okay, so if you were to put, for example, $1,000 into an option contract, you can see a potential return of $300 to $6,000, and you've only tied up $1,000 of your capital, right? That's really the big difference. Now, the downside of this is time decay. You don't have the ability to hold this all day long because as time passes, the value of your contract will drop. So those are the Greeks I'm referring to, the theta on an options contract. So the average person is going to be looking at this side of the equation simply because, one, they're going to have less capital to start with. Two, they're going to see bigger returns. And three, they can manage risk better. What I mean by that is if you put $1,000 into that contract, the max you can lose is $1,000. Whereas here, you're trying to chase a 2% move, but if that stock drops 10, 20, 30, 40%, you're already in so heavy, you're going to see a bigger loss. And the average person doesn't know, or the average new trader doesn't know how to manage risk. So that creates a big problem trading shares. You have too much investment into that stock to see such a small return. And if at any point it ever goes against you very drastically, the average new trader is not going to take that position up. Whereas here, if you trade with $500, the max you can lose is $500, right? But you have such a huge upside that you can take advantage of. So a lot of people will start trading options to grow their account, and then they can slowly invest into long-term stocks with shares slowly buying and dollar costing down. So I love options trading because I don't have to tie up $200,000, $300,000, $400,000 in my capital. I can trade with an $8,000 per trade position size and see huge returns of anywhere from 20 to 50K based on that position size that I'm trading. So we talked about whether it's going to be options or shares based on what your trading strategy or what you're feeling or how your emotions are, how type of person you are. You can decide the avenue you want to go. Again, I do options. That's just what works for me. Now, let's talk about position sizing. Position sizing is very important. When I speak to so many new traders, a lot of them tell me, hey, Ali, I've been trading options and I only take one contract. Okay. So to me, that's not position sizing. That's not managing position size. One contract on Tesla could be $5. Okay. So what that means that $5 is always multiplied by 100. Okay. So it equals $500. That means you're putting into the trade $500. If you lose 20%, right, your loss is $100. Okay. Now, if you take one contract of NEO, which is 0.5 cents per contract times 100 equals $50, a 20% loss would mean you lost $10. Do you see the big difference here? I'm only trading one contract. That's absolutely irrelevant. Your contract size should have has nothing to do with position size. Position sizing needs to be based on the dollar size you're trading. If you want to trade with $500 and your max loss is going to be 20%, which means you're only willing to lose $100, then every single trade needs to be $500. So what does that mean? That means you don't take one contract of NEO. Now you take 10 contracts of NEO. Why? Because at 50 cents times 100 times 100 shares equals 500. Right? Now you've taken the same position size as Tesla and your max loss will be 100. Okay? So contract size will always vary. Okay? Now let's say we want to take another trade. We want to trade Netflix, right? Netflix contracts are $1. So in this case, you would take 5 contracts of Netflix times 100 times 5 equals 500. And your loss will be $100. Okay. So the contract size is variable. The dollar size is what's always consistent. So remember that. The dollar size must stay consistent, not the contract size. Okay, hopefully that makes sense to you guys. And the same thing goes with you when you're trying to trade shares. When you're trying to trade shares, what you're looking at is, okay, if this is the stock, right? That's the stock, and we're looking to establish where our stop is going to be. And if our stop is going to be down here, and this is a 3% drop, right? Then we can say, okay, so the potential of the stop being hit is 3%. And if I want to lose $300, or if I want to lose, $30, then I know how many shares I need to take based on this pullback, because that's going to be a 3% drawdown. So if I want to only lose $300, the max position size I can take on this trade is going to be $10,000, because 3% of that is going to be $300. So that's how you establish where and what size you need to take. Okay, if your max loss is always going to be $300, then you can establish what position size you need to take based on your risk. It shouldn't be the same number of shares every time, because that value is going to change, right? It should be $10,000 per trade, or it should be $5,000 per trade if you're doing shares. If you're doing options, well, we've already explained how that should look, right? It's a dollar size per trade rather than a contract size per trade. All right, now let's talk about risk. We touched on this a little bit in the position sizing training. Now let's talk about risk and how to assess how much risk to put on or put into every trade. Okay, a lot of people say, okay, risk 1% of your account, or risk X amount of percentage of your account size. All of that is nonsense. Okay, because first of all, you don't know how emotional you will be if you lose 1% of your account, so that immediately puts you in an emotional state, which we know is the biggest aspect of trading failure. So what is it that we need to look at? A lot of the times I ask students, how much are you willing to lose per trade? So they tell me they're willing to lose, $300. Great. That's an awesome thing. At least you know how much you're willing to lose. Now, the problem with that is, what happens if you lose 3 trades in a row? Now, your $300 per trade loss is $900. Are you still able to stomach that? Now, that becomes a different conversation. People are like, oh, okay, you know what? If that's the case, maybe I'm willing to only lose $300 per day. Great. So that gives us about $100 per trade if we're going to take about 3 trades a day. So great. Now we went from $300 loss per trade to $100 loss per trade. Now I asked the question, what happens if you string along, 4 days in a row of losses? Are you still able to walk away with a $1,200 loss and still be emotionless? So now the conversation changes again. Okay. So what is your max loss? Okay. You have to ask yourself, what is the max loss per trade? Okay. Is it 300? Are you willing to lose 300 per trade? And how many trades are you going to take per day? If you're going to take, 3 trades per day times 300 equals $900. Are you willing to lose $900 per day? So we did the math. We said, okay, we're only willing to lose, $50 per trade, because we're going to take 3 trades per day. So $50 times 3 equals $150. Great. So that's $50 is how much we're willing to lose. Okay. If we're willing to lose $50 per trade, what's the position size we need to take? Well, then we have to ask ourselves, how much are we willing to risk, right? Percentage wise per trade. So if we're willing to lose $50 and our max loss is going to be about 20% per trade on the option side, well, that gives us what? That means if we take $250 per trade at a 20% stop loss equals $50. So now we know that average position size we want to take is going to be $250 per trade. Why? Because we did the math backwards. We asked ourselves, how much are we willing to lose per trade? Are we okay with 3 times that loss in a single day? No. We go back down again and we establish we're willing to lose about $150 a day in case we have 3 or 4 losing days. And that equals $50 per loss per trade. So $50 per trade, the average trade, let's say you want to have a 20% stop loss per your trade. That means you can only take $250 position sizes at a 20% stop loss equals $50 per trade. Okay. That is how you calculate the option side of things. Now on the share side of things is a similar thing, right? We just have to establish where our stop loss is going to be on the chart. So let's say we have a pattern like this and we're looking to take this pennant breakout. In accordance with technical analysis, obviously this is going to be your entry and this is going to be your stop loss. Okay. Now, if this stop loss from here to here is 5%, we know that we're going to get stopped out at a 5% stop loss. So then we ask ourselves again, how much are we willing to lose per day? We do the same equation again. Let's say it's $50. So if we're willing to lose $50 and we know the drawback is 5%, then we just simply do the math. So if this drawback is 5%, we know that our position size needs to be $1,000 because at a 5% stop loss equals $50. So that's how you establish your position size. So this means that you're going to take $1,000 worth of shares for this stock price. So if the stock price is $2, you're going to take 500 shares. If the stock price is $5, and if the stock price is $10, you're going to take 100 shares. Okay. Same thing with when we were doing options. The contract size constantly changes based on the dollar size, which we talked about in the shares in the position sizing lesson. The same concept here, right? Your number of shares are always going to change because your risk is consistent, right? 5% with a $50 loss means you have to take these type of positions based on the share price. So we talked about position sizing, we talked about risk. Now let's get into talking about what to trade, what time frame, breakout, pullback, and what to look for. So in the previous lessons, I talked about how to find stocks to trade, okay? And in my previous videos, I've shown you guys how to build that list of finding stocks to trade and then coming in the pre-market, looking at it and establishing, where to enter that trade, okay? So you build your list of stocks, okay? So we did this with Finviz, okay? Then you come in to the pre-market and you establish if that thesis is still valid. Okay. If that thesis is still valid, you are now going to look at the 2-minute, 5-minute, or 15-minute. But for day trading, I like to stick to these two right here. The 2-minute and the 5-minute. If you're swing trading, well, then that's a different conversation. Watch my swing trading video. All right. So 2 minutes, 5 minutes. Okay. Now, are you going to be trading the breakout, the pullback? What are you really going to be focusing on? Okay. I have a rule that I follow. All right. So the market opens at 9:30. Okay. So from 9:30 to around 9:40, I take trades without waiting for, a candle close or anything like that. If I have a pre-market setup, let's say I have the dailies in a pocket. Let's say everything is already done on the scan that we've done. We've done this Finviz scan. We have our list. We're looking at it in the pre-market. Everything's still valid. And in the pre-market, we have nice area of resistance that we've constantly hit. And we have a nice level of resistance. When the market opens between 9:30 to 9:40, I'm taking this trade right as it triggers over this pre-market level. Okay. So I'm not waiting for any sort of confirmation because the daily is my confirmation, the pre-market is my confirmation, and as soon as we trigger above that level, I'm entering the trade right as we break through that, expecting that strong momentum move to the upside. Okay, that's within the first, 5-10 minutes. So if you're looking to take a trade within the first 5-10 minutes, higher risk. So you have to make sure that your work before the market opens has been done. Your scan, making sure it's in a pocket, making sure the daily has room. All that stuff has to be on your side if you're going to take this 9:30 to 9:40 trades. Okay. Now, what time frame? Again, we're going to be using the 2-minute and the 5 minutes. Okay. Let's say 9:40 has passed. It's now, 9:45 till 11 a.m. In this scenario, you always want to wait for a candle close and a volume spike. Okay. Let's say we have a scenario where the stock is consolidating, giving us a nice little pennant or flat top, and we want to take that trade. Okay. If this is our level of resistance and the time is between 9:45 to 11 a.m., what we want to look for is not only for price to go through this level, but also the volume bars down here. We want to see them spike at the level of breakout. And we also want the candle to close. Okay, so let me write that down. Pattern, 2, volume spike, and 3, candle close. Okay, so we need these 3 things from 9:45 to 11 in order to take that trade if we're taking a pattern setup. Okay, if we're taking this a setup where the setup is simply just a support and resistance breakout. So let's say we have resistance, and let's say we have support, and we really just want to take the price action as it comes up and as it breaks over this level. Well, from 9:45 to 11, you want to wait for not only a candle close but a retest of that level, and that's where you get involved on the entry and take the move higher. Okay, so on a support and resistance setup, you want to wait for 1, again, volume spike, and 2, candle close, and 3, retest of level. All right, so this is a pattern, and this is support and resistance setups. All right, this is how I categorize my trading. If I've done the legwork the night before, I know the stock is in a pocket, I know the stock has room on the daily and it has room to go. If the pre-market looks good, within the first 5-10 minutes, I'm entering the trade as it triggers. Okay, now from 9:45 to 11, if I see a pattern, great, that's good, right? I have a pattern. If that pattern breaks out, does the volume spike? Great. And do we get the candle close? If all these are in our favor, we will enter the trade. Now, if it's just a support and resistance setup, well, then you need to see a volume spike at that level. You need to see a volume spike once that level breaks out. And you want to see a candle close, and potentially the retest is the entry. All right, so now we talked about the time frame, the breakout, the pullback, what to look for. Now let's talk about what expiry to choose and why. So when we're looking at what expiry to choose for your trades, you have to ask yourself 2 questions, or actually 1 question. Is it a day trade or is it a swing trade? And either one is fine. It doesn't really matter. The only thing that really matters is the time frame that you're using, right? So if you're using the 2-minute, 5-minute, 10-minute, then you're going to be day trading. But if you're basing your trades based off of the daily and you're looking to take advantage of that pocket for a bigger move, then you're going to be swing trading. Okay, so let's say that you're day trading. If you're day trading, you're not really worried about theta. Okay, theta is time decay. It means the longer you're holding that position, the more it loses value. So when we're day trading, we're looking to get into the trade, let's say in the morning, and be done within 5, 10, 15, maybe the latest a few hours. Okay, so we're not really too much worried about time decay in a day trade. So to put it in perspective, let me type this out. It'll be a lot easier. Monday to Thursday, same week expiry. Okay, and then Friday, lotto, same day expiry. This is the rule I have when I'm looking to trade options for day trading. Okay, if it's Monday to Thursday, I'm choosing the same week expiry, and this is going to be full size. Right? We talked about position sizing. We talked about when we're willing to take. This is going to be full size. So if we establish that, our full size is going to be $250, so that's going to be the position size I'm going to take Monday to Friday, and I'm going to be risking 20% per trade. Right? Now, if it's a lotto, this is where a lot of people make big mistakes. They think that they're going to use the same position size on a lotto trade. We're not going to do that, right? The reason for that is when you're trading lotto, time decay is against you because it expires that same day. So every hour decays your contract a lot more. So with that said, on Fridays, I use 1/10 of my normal size, and I have 100% risk. So if I'm taking the contract position size of 250 Monday to Thursday, on Friday, my position size is going to be $25. And if I enter the trade at $25, it's going to be 100% risk. Why? Because if I make a trade Monday to Thursday and I take 20%, that's going to be a $50 profit I have. Okay. Now, if I string along a few of those, I have a few $50 that I've made, maybe $200-300 on the week, let's say. On Lotto Friday, I'm going to use 20%, $25, and it's going to be 100% risk. So if that trade goes against me at 100%, I only lose $25. It doesn't take away too much of the profits I made throughout the week. Now, had I used an entire full 250 size, it would have decayed so much so quickly that I would have gave back maybe 5, 6, 7 of my actual profits for the week. So this is how I manage my expiries and position size and risk by doing it this way. Okay. Now, when you're swing trading, you're looking to buy time, right? You need to buy time because we don't know how fast or how soon that swing trade is going to pan out. So in that case, we want to take at least 4 weeks out or 2 months out. Expire. Okay. This way, we're buying time, eliminating time decay. Okay. If we do a same week expiry for a swing trade, we're likely going to expire worthless because we don't have enough time. So for your swing trades, buy time 4 weeks out, 2 weeks out. And for your day trades, Monday to Thursday, same week expiry, and Friday is a lotto. So you're going to choose 1/10 of your average position size. Now let's talk about how to track your trades. This is probably the most important thing because if you don't know where you're going wrong, you're not going to know what you need to fix. Okay, so we need to talk about how to track your trades. So tracking your trades can be pretty simple. Okay, I have a tracker that I've made here. If you guys want access to it, just simply message me on Instagram and let me know. There's going to be a link down below as well that you can download this tracker. Pretty easy stuff. But essentially, you want to make sure that you're tracking a few things. Okay, your win rate. You want to make sure you're tracking your average loser. Okay, and you want to make sure you're tracking your average winner. All right. These are probably the most important things you need to track, right? Because if our win rate, if win percentage is down, is low, we need to work on entry and exits. Okay. This is telling us that there's something wrong with our analysis, with our thesis, with our technical skills, with our pattern recognition. This tells us that there's a problem with the entry and exits. Okay. Now, if your average loser is too high, right? If your average loser is high, then that's pretty straightforward. You need to work on cutting your losers faster. Okay. And then, of course, if your average win is low, well, then you gotta hold your winners. All right. This is what this tracker is going to tell us. But most importantly, okay, I want you guys to have a section on your tracker that's going to tell you notes. And you're going to write notes on every trade. What happened? What went wrong? What you did? Where did you enter? Where did you exit? Remember, I don't want you to do this at the end of the day or at the end of the week. You write your notes immediately as soon as that trade is over. Okay? Because that's when it's freshest to you, and that's when you remember the most about that trade. So make sure that you input those notes and your thought process for that specific trade right after that trade is over. The more you track your trades, the more you're going to get an understanding of what you need to fix, what the problems are, before you're ready to become a trader that's making, 5-6 figures. You need this down pat. There is no questions about it. The top traders in the world track their trades, and you are no different. You have to track your trades. If you think there is a way around it, then you're probably the reason why you're still where you are today is because you're not doing things correctly. This video is telling you step by step what you need to do. So follow it and track your trades. So this is a very basic template. All you need to track is your win rate, your average loser, average winner. You don't have to use this tracker. You can use any one that you want. You can even pay for subscription ones that are available online. But the simple Google Sheet, you're able to access this and you don't need to pay. All right. So now we learned that, how we're going to track our trades. What are we going to use? We're going to use a tracker. Any system that you want. Make sure you track your trades and what do we look for. Okay. Now let's talk about what stats we need to look for before we start scaling. All right. So what are the stats we need to look for before we start scaling? I'm most concerned about how consistent you were with your position size, your average loser, and your average winner. Okay. I'm not too worried about your win rate because let me tell you, I've had some of my best months with a 53% win rate. Okay. So the win rate is not the problem. It's more so how you manage those trades that you're in. Okay. So you always want to make sure when you're looking to scale, okay, when you're looking to scale, the main thing you want to look for is that the average loser needs to be below 20%. Average winner needs to be above 20%. And your win rate at the least needs to be 50%. Okay. As you can see, when you have a 50% win rate with a 45% average winner, you're still going to have a profitable month. Okay. This is one of my stats from back in November 2024. So these are the things you want to look for. You want to make sure that you have your average loser below 20, your average winner above 20, and your win rate is at least 50%. Okay. These are the statistics you need to look at. So we talked about what stats to look for before scaling. Now, when do we scale? All right. Now, what do we look for before we scale? All right. Now, when do we scale? Okay. We scale after we see consistency, not in days, not in weeks, but in months. Okay. So let's take a look here. This is Lori. She joined back in April 2023. Okay. She started with a $400 position size. That's what me and her agreed on based on the risk conversation we had earlier. Okay. So we established that she's going to take $400 per trade. In April, she finished with 2,500. The numbers looked good. Everything was fine. She took, quite a bit of trades, and it was 30 days. So we didn't scale her position size then. That's not how this works. This is a game of consistency. So again, in May, $400 per trade, and we were again consistent. We were consistent in profits. We were consistent in position size. We were consistent in P&L. All right. So then again in June, we were still keeping the same position size. We didn't increase. Everything was still fine. Profits were still good. And again, in July, same position size. So 4 months of being in the mentorship program, we kept the position size consistent. Okay. Month number 5 is when we bumped it up to $600. And again, $600 was consistent in September, and $600 was consistent in October, and $600 per trade was consistent in November. However, you can see that she's improving because the P&L is slowly moving up, right? We kept it consistent for 4 months at 400, and month 5 we went to 600, and the P&L slowly started moving up. Again, after 4 months of being with a $600 position size, in December 2024, we moved it up to $800 per trade. We moved it up to $800 per trade. Okay, so she joined back in April 2024. In April 2024, for 4 months, we kept it at $400. And then another 4 months, we kept it at $600. And in December 2024, we bumped it up to $800 per trade. And look at this. She finished the month of December with $7,546. This is consistency. You guys can take a screenshot of this. Look at these stats every single month. It's been consistent. The average winner was above the number we were looking at. The average losers was below the numbers we were looking at. And everything was perfectly what we needed to do. We took our time. We scaled. Now she's sitting at a place where she's replaced a full-time income, making $7,500 per month. Okay, so that's when you scale, is when you see consistency, not in days, not in weeks, but in months, and then you scale the position size. And you don't even scale the position size double. You add $100, $200, and you slowly move up from there. Never double your position size when you're scaling. Always move up incrementally and slowly. So we talked about what stats to look for before scaling, when to scale. Now let's talk about what to do when we hit hard times or we hit bumps on the road where trading just seems like it's not working. So this is how you stay consistent during hard times. You definitely do not change strategies. Okay, if you have a strategy that works, that's been working, you don't just change it because you're having an off month. In fact, you buckle down and you focus. So this is my January trade tracker. Obviously not the best start to the month, but you can see that I'm sitting at a 57% win rate. It's not amazing, okay? So what do you do when things like this start happening? Obviously, you need to track so you know whether or not you're having a good or bad month. By tracking, you'll then know, do I need to put the gas to the pedal and take more trades, or do I need to step back? In my case, it's the 25th of January. I know that my win rate hasn't been the best. So I've only taken about 21 trades. That's less than one a day. Okay. But the most important thing here to know is that because I know I haven't done the best, I haven't performed as good, I can say that I'm cutting my losers a lot sooner than 20%. And in fact, those trades that I'm in that are working, I'm holding them a lot longer. Right? My average winner is 40% on an $8,000 position. Okay? So when things get hard, don't change the strategy. Buckle down on focus on taking less trades, cutting the ones that are not working, faster and holding the winners that much longer. Okay. This is what makes you a good, consistent trader. A good, consistent trader doesn't constantly change strategies. A good, consistent trader doesn't constantly change position size. A good, consistent trader doesn't constantly change the way they do things. The same strategy day in and day out, because it's been proven to work in bear and bull markets, which is what I've just proven to you guys here today. So make sure that you're not just changing your strategy, but buckling down, cutting those losers a lot sooner. When you're in a winning trade, hold them a little bit longer. So at a 50% win rate, you're going to come out profitable. Now, we talked about all these different things. This was an entire masterclass on what I do from the bottom up. Taught you guys everything from the start to the finish, and even when to scale. And I put it all on this mirror board here. Okay, if you guys want access to this, simply get this video to 100 likes, and I'll send each and every single one of you guys the PDF of this, so you guys can have it alongside this video. And hopefully you guys learned something from this. The most important thing that you can take away from this video is consistency in position size, consistency in your risk management, and consistency in having the discipline to stick to it when times get hard. Now, I hope you guys enjoyed this masterclass that you just watched, and I hope that you took some value from this. Remember, at the end of the day, consistency is what's going to make you a profitable trader. Now, you guys saw Lori and see how consistent she was. You guys know my students are seeing 150 to 200,000 per year using this exact system that I've shown you guys. But the key important factor of all this is the one-on-one mentorship and coaching that people get in my program to help them become a profitable trader within 5 to 6 months without losing a ton of their capital and without them wasting 2 to 3 years trying to learn it on their own. That's the key thing. And if you guys want to work with me one-on-one so I can get you to those numbers a lot sooner, all you have to do is click the link down below, see if you qualify to work with me one-on-one, and I'll be more than happy to mentor you. And if you're not ready for that, that's absolutely not a problem. All you have to do is watch this video right here, another free training that's going to help you become a better trader.